Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Chipwreck. The semiconductor rally sails into choppy waters as our scoop on Meta's cloud business plans raises concerns over the speed of the AI build-out. Receding risks. Fed Chairman Kevin Warsh says that price pressures have eased, but the fight against inflation continues. We'll preview the US payrolls report due today ahead of a public holiday. And crude prices ease for a third straight day as a US official says that oil flows through Hormuz have now hit 10 million barrels per day. Well, welcome to Thursday. We've had a marginally dovish Sintra, arguably, and a plunge in oil prices. But the big story in Asian markets this morning is the semiconductor sell-off. Korea's Kospi down nearly 5% this morning, not helped by Meta reporting plans to build a cloud infrastructure business, that fueling concern that it's overbuilt capacity. And not helped either by this Bloomberg scoop that Apple's in talks to buy chips from two Chinese semiconductor makers, which, of course, wouldn't help South Korea. So it's a catch-up trade that has been around the world. But now futures on both sides of the Atlantic are pretty flat. So signs of stabilisation coming through for the day ahead when it comes to the US and Europe. Now flip the board cross asset. And as I say, oil is down as flows through the Strait of Hormuz pick up. Brent peering over the edge into the 60s this morning, down nearly 1%. Treasuries holding on to their losses, the 10-year yield up a basis point at 4.48. And do note that the trade in cash treasuries will close early today at 7 p.m. London time. But gold rising for a second day, trading above $4,000 an ounce after Fed Chairman Kevin Warsh said that price risks have come down in recent weeks. So bond traders a bit less convinced of that narrative, but gold up nonetheless. That's what's happening in the markets. Let's take a look at what's on the agenda for today. At 10 a.m. London time, we'll get Eurozone unemployment figures expected to hold at 6.3% in May. But of course, the big focus of the week when it comes to the data is the US jobs report. That at 1:30 p.m. London time as the debate rages on rate hikes. We already saw a strong gain in May, not quite as big a gain expected in June. Consensus is 115k, the whisper number 138k. And then to cap off the day, we shall hear from the Bank of England's Catherine Mann at 4:45 p.m. London time. So plenty on the docket before the July 4th holiday. Let's set you up for the day ahead. We begin with stocks in South Korea leading Asia lower on this fresh concern about the AI build-out. We can go straight to Avril Hong in Singapore for an update. And Avril, when we look at it, it seems the Kospi in the red again this morning, dragging down the rest of Asia. Good morning.
Yep, that is where the bleed is coming from for the region. South Korea is the drag, and this is coming against the backdrop of investors reassessing perhaps has the AI-driven rally outpaced fundamentals, and perhaps these concerns getting compounded by these reported plans from Meta and Apple. How much AI build-out do we really need? So flip the board. This is where the concerns, I think, are showing up in the market in terms of the memory trade. SK Hynix is really the one that is leading the AI trade lower today. We're keeping watch on SoftBank as well on the back of those OpenAI reports. But what is also interesting to me is what you're seeing in Japanese, South Korean financial stocks, because they are in the green along with some of those recently very beaten down Chinese internet names. So maybe that also speaks to investors looking for fresh narratives in the second half of the year, aside from the really popular, really crowded AI trade. Now flip the board again. Bonus FX read through for you in the form of the South Korean currency that is on the back foot for a fourth session. Perhaps no surprises given how we've been seeing the stock selling, especially today. So that is one currency that is not benefiting from the reprieve we're getting from the slight pullback in the greenback on the back of Kevin Warsh's comments and what that means for the Fed trajectory.
Okay, Avril Hong in Singapore, thank you very much for the update. And let's dive into the tech story, shall we? Because Bloomberg understands, as Avril says, that Apple is in negotiations to buy chips from 2 Chinese semiconductor firms, which are currently on a Pentagon blacklist. Now, the tech giant is said to be seeking the chips in order to reduce the impact of the global memory shortage that so far has forced it to raise prices across its products. Let's go now to Bloomberg China correspondent Min Lo for more. Min, just talk us through what we know about this deal. Are we going to expect blowback from the Trump administration? Good morning.
Yeah, that's hard to say, but certainly I think Apple is putting in the preemptive steps here because we know the CEO, Tim Cook, has been in talks with Scott Bessent, the Treasury Secretary, to discuss this deal. Technically, Apple doesn't need U.S. permission to do so because even though those 2 companies are on the Pentagon list, that prevents the Department of Defense from buying from the companies. It doesn't prevent a private sector firm like Apple from doing so. One of those Chinese firms called Angst Memory Technology is also on a separate list, which is the Commerce Department entity list. Now, this is separate from the Pentagon list, and it prevents U.S. firms from exporting or transferring their technology to these Chinese firms. But in this case, Apple is not looking to buy. Apple is not looking to sell its technology. It's looking to buy from Angst Memory. So again, it's not going to violate U.S. export controls. But because of the sensitivity and the concern around over-relying on Chinese suppliers, there is some scrutiny on this. And Tim Cook, I think, is really preparing to use these chips only in those devices that they sell in China in order to prevent any fallout with the US government.
And the other big tech news is that Meta is developing plans to sell access to its AI computing power. Why is the market taking that badly?
Well, because everybody thought that the capex from Meta was going to feed its own need for data compute. But then now that it says it's going to sell, it raises the question about whether or not Meta had overcommitted when it comes to its capex, right? So it's now going to participate in the same space as companies like Amazon as well as Google when it comes to providing cloud servers to other companies, whether it's raw computing power or in the form of API services where they allow developers to access the AI models that are hosted on Meta's infrastructure. So yes, overnight we saw a big pop in Meta's shares because that would provide a new source of revenue for the company. But then the concern comes through when it comes to the suppliers, the picks and shovels of the AI data center trade. Companies like Samsung, SK Hynix taking a hit because it raises questions about the demand outlook for these companies going forward.
And let's throw in another story here because the Financial Times is reporting that OpenAI has proposed giving the Trump administration a 5% stake. You've also got the White House accelerating plans for AI model standards. Just tell us more about how that all feeds in.
Yeah, this is quite interesting, right? We know OpenAI is looking towards an IPO, and we understand from Financial Times reporting that they are now in talks with the US government to have the government take a 5% stake. And this is a bid to really redistribute wealth to the government and the people. They're proposing using a vehicle like a sovereign wealth fund or some sort of a public wealth fund that can invest the wealth into stocks that pay dividends to the government and the people. And it's not just involving OpenAI. Their proposal calls for the US government taking a stake in all these frontier AI firms, including the likes of Anthropic, Meta, Google, for example. Of course, it's not clear whether these are the companies who would would be on board with that plan, but clearly it's a bid to get on the good side of the US government at a time when there has been all these national security scrutiny. You look at what happened with Anthropic, with the Commerce Department initially putting some foreign access restrictions on its products. So it's really trying to get on the good side of government and also address concerns around potential AI jobs displacements and, the widening gap between the digital haves and have-nots.
Okay, Bloomberg's Min Lo, thank you very much for taking us through all of those stories. We are seeing Nasdaq futures creeping ever more into the green now, up 0.2%. But still ahead on Daybreak Europe, a blow to the European defence sector as tank maker KNDS postpones its IPO. But first, Fed Chairman Kevin Warsh dampens expectations of a rate hike with his comments in Sintra, Portugal. We'll get you more on that next. This is Bloomberg.
the price stability business. That might not be our only business, but if there was a common thing I heard over the last couple of days, it was open-mindedness on these questions of AI, open-mindedness on productivity. But we've all looked around and we've seen that prices are too high, and I don't think I'm the only one on this stage that's recommitted to deliver price stability.
Fed Chairman Kevin Walsh speaking there at the ECB forum in Sintra, where he also repeated his determination to bring inflation back to the 2% target. Let's get some analysis now. We can speak to Bloomberg MLive strategist Marc Cranfield. So, Marc, you had Walsh saying that he's determined to tame price growth. We've heard that before, that he's really sticking to the Fed's independence. We've heard that before. We've also heard that he's not going to offer forward guidance. But what was new was him saying that price risks have come down in recent weeks. So is it fair to characterise this as a bit more of a dovish Walsh that we saw yesterday?
I think that's going a bit far to call him dovish. I think what he's doing there is he's trying to give away as little as possible. I think he's trying to get people to go into the July FOMC meeting thinking that there's a lot of things on the table here, and depending on the way the discussion goes, and he seems to be a man who wants to have a very open discussion among the Fed members. And that's partly why traders are starting to price for the chance that they will go for an interest rate hike, probably sometime, not necessarily in July, but in a meeting soon afterwards, maybe September, if not October. Because clearly the data has been pointing that way. European Central Bank has already moved. We've seen the RBA in Australia move much earlier as well. So clearly the risks are slightly skewed that way. He doesn't appear to be doing anything to draw back from that, which you may have expected him to do at Sintra. Now, today on the terminal, there's a very good macro view from our colleague in London, Skylar, and she's saying, what are the main risks if the Fed does start a hiking cycle, even if it's not a very long one? Emerging markets better watch out. Assets across the board in the EM space will be hit pretty hard by that. The bond market, obviously, around the world, G10 bonds, treasuries, they won't like it very much either. But because of the durability of the US economy, you'll probably see US stocks. They will be one of the safer places within that scenario. So if we do get the start of a Fed cycle, it's going to cause quite a lot of disruptions around the world, on top of all those AI scares that you're talking about today in Korea and other places as well. So certainly people will go into this meeting expecting more volatility. And that's probably the consistent theme that you are hearing from traders and investors, is that Kevin Walsh is likely to raise the bar in terms of volatility rather than lower it.
And of course, feeding into that decision will be the US jobs report later today. Contrary to consensus, Marc, our economists actually see a rise in non-farm payrolls. How much would a figure like 200K that they've cited boost rate hike bets then?
On a day when the bond market is finishing early, it would be pretty ugly because people will be rushing to get their trades done before they go off for the long weekend. So that would be a pretty messy afternoon if you happen to be involved in the Treasury market. Even without that, the unemployment rate is probably going to stay around 4.3. We know the market is pretty strong. There will be concerns if people start talking about anything that suggests that the AI is cutting jobs a lot more in the white-collar sector. That would be a concern, but that's, again, something which people are pretty well aware of. More important, really, is the CPI report in 2 weeks' time. That's the one that's been a bit sticky. We've seen core inflation's relatively high. PCE numbers were very high last week as well. So there won't be too much disruption from the jobs data, but certainly a high number will spark some action in bonds especially. But really, we're looking ahead to those inflation reports, and that will be the justification, if any, for the Federal Reserve going from an early interest rate hike or delivering a very hawkish message which sets up a rate hike for slightly later in the year.
OK, Marc, thank you very much for the preview. That's Bloomberg MLive strategist Marc Cranfield. Well, Marc also mentioned some of the ECB speak that we heard at Sintra. Officials split, really, on the path ahead for rates as markets price about a 50-50 chance of a move higher at the central bank's September meeting. President Christine Lagarde told the events policy panel that the outlook is changing.
And I think risks, by the way, that we have to the upside on inflation and to the downside of growth are probably more broadly balanced than they were a few weeks ago as a result of what we're seeing, which happens at speed. If you look at how fast the price of oil, spot price granted, has moved down
Let's bring in Bloomberg's Zoe Schneeweis for more. Zoe, good morning. I mean, we've heard loads of ECB speak at Sintra, not just on the airwaves and the panels, but your team working the corridors as well. What's your main takeaway from what we've heard overall at Sintra?
There are two main takeaways here. First of all, July does seem to be off the table for a rate move. After the June decision, obviously that was before there was a ceasefire, policymakers had very much told us that July was a live meeting. That now seems to be off the plate. On the one hand, on the one side, it's obviously the developments in the Middle East. On the other hand, we also have seen those inflation numbers. Bloomberg Economics, for instance, thinks that inflation in the euro area is already past peak. The other thing we have seen is that even what happens in September seems to be up for debate. Policymakers who really, if you look at the record of the last meetings, and Lagarde always highlights this, that decisions were unanimous. For September, seeing a unanimous decision at this stage is quite tricky. Also, the divide that we've seen has been less along the normal lines. We've had some of the policymakers who we would traditionally consider hawks, like Belgium's Pierre Wunsch, now saying he's not sure if any more hikes will be needed at all. So these are situations where I just think the ECB will remain very exciting to watch.
Well, if they're data dependent, as they tell us they are all the time, what's going to shape the ECB's decision making then between now and the coming meetings?
So we have two meetings coming up. First of all, we have one in July, which probably we don't have that much data for. We just got the inflation number this week. We'll have some PMI numbers. More importantly, after the July meeting and before the September meeting, which does look like it'll be the crucial one, we will have second quarter GDP numbers. These could be quite bad, quite poor because of the situation, because obviously the Iran war was in the middle of all that this second quarter. Then we'll have more inflation numbers, we'll have PMI numbers. It'll be exciting. It'll be, again, we don't know. Numbers at the moment are so unclear, especially the forward-looking indicators, things like PMIs, where you're reliant on the news that's out there. If we as ECB watchers, as economy watchers, don't really know what the situation is like in the Middle East, purchasing managers who are a step further away from watching the news are just as ill-informed as we are at times. So them then saying what is their feeling for these things is difficult to gauge.
Okay. Zoe, thank you for the update. That's Bloomberg's Zoe Schneeweis. And next, we are going to try and make sense of what's going on in the Middle East. We'll dive into the geopolitics. We'll talk about this surge in commercial shipping through the Strait of Hormuz, with details on the reopening of that crucial waterway. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:22 a.m. here in London. Well, President Trump says that negotiators have made progress during indirect talks with Iran as both sides seek a permanent end to the war. Despite differences over Lebanon and the Strait of Hormuz, the US says that at least 10 million barrels of oil are now flowing through the critical waterway daily. Let's get more now with our Bloomberg Horizons Middle East and Africa anchor, Abir Abu Omar. She joins us now. Abir, the US sounding increasingly positive about flows through the Strait. Do we know if Tehran shares that sentiment and what the actual breakthroughs have been when it comes to the talks?
Good morning, Lizzie. Yes, the U.S. has been quite positive over the past week or so. Even the negotiations that took place in Doha were flagged as quite positive by the negotiating team there and President Trump. But when it comes to the flows of the movement in the Strait of Hormuz, what we have from a U.S. official is about 10 million barrels a day that are going through the Strait of Hormuz. And just to point out that this is broadly in line with Bloomberg reporting about the number of barrels that are now making their way through the Strait of Hormuz. So again, some positivity there. That compares with about 20 million barrels before the war. So we're seeing an upward trajectory when it comes to the movement of oil barrels. Now, when it comes to the negotiations that have been happening in Qatar, we understand that there are technical negotiations. More is expected to happen. Qatar did say that we're supposed to see an extension of those talks after the funeral of Ali Khamenei, the previous supreme leader in Iran, is carried out. That starts on the 4th of July. July, so end of this week, and carries out for 4 days. And so after that, we're expected to continue to see negotiations between the two. Lizzie, the contentious issues continue. The Strait of Hormuz, tolling it is one of them, the nuclear component, the frozen assets, and the oil sanctions. Those continue to be on the table and continue to be discussed through the 60-day period of which this MOU is going to be ensuing. And so we continue to monitor those developments, and as Qatar has called it, and both sides have called it, the technical negotiations and the positive trajectory of those.
Okay, Abir, thank you for the update. That's Bloomberg's Abir Abu Omar out of Dubai, and she'll be back with Horizons at 5 a.m. London time. Well, linking to that, the oil majors in Europe have flipped from winners to losers in the stock market as the easing Middle East tensions lead investors to turn more selective when it comes to energy. The region's sector index returned more than 20% in the first half of 2026, helped by that spike in oil prices despite the June sell-off. Now it seems the tables are turning. So let's get more now with Martin Kazanic, who has been part of Bloomberg's FX and Central European team. Good morning to you, Martin. Just talk us through how the fortunes of European energy are changing. Because really, as I say, this sector has been one of the best performing in the first half of the year. Why are investors becoming so cautious now?
So, hello, good morning. Yes, indeed, European energy stocks have had a very strong first half this year, but much of that was driven by higher oil prices and geopolitical tensions, obviously. Now that the Strait of Hormuz has reopened and the immediate supply fears have eased, there's even talk of a glut in oil markets in 2027. So investors are asking what the next driver is, and many strategists think that the sector can still generate strong cash flows and dividends, but they no longer expect it to outperform the broader market. So they are becoming a little bit more selective.
So if I'm trying to select well, why have some companies done better than others? So investors are no longer buying the whole sector, but rather go for specific stories. The outstanding one has been Saipem and Subsea 7 in Europe. These are two oil service companies, an Italian and a Norwegian one. They have benefited from their merger announcement and very strong order books. Also, Tenaris, an Italian oil service firm, is gaining from resilient drilling activity. On the other hand, companies like Shell and BP, so like large integrated companies, don't really have those obvious near-term drivers. They still generate a lot of money and cash for shareholders, but investors are asking, what drives the shares higher from here. Okay, Martin, thanks for the analysis. That's Bloomberg's Martin Kazanic. Thank you. Well, now to some other top stories that we're following this morning. The US has decided not to renew a trade deal with Canada and Mexico and will instead review the USMCA pact. Trade Representative Jameson Greer told Bloomberg that the Trump administration is not prepared to rubber stamp the agreement, which remains in force for another decade. President Trump signed off on the original USMCA in 2020, calling it the best and most important trade deal ever made. And elsewhere, the SEC is said to be looking into claims that unknown insider traders made $100 million on options bets ahead of a Chinese regulatory crackdown. Bloomberg has learned that the regulators examining trades described in a lawsuit by the Susquehanna International Group. Well, coming up, central bankers appear divided at Sintra, but our next guest says that the case against rate hikes in Europe is strengthening. So we'll discuss the outlook next. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Chipwreck. The semiconductor rally sails into choppy waters as our scoop on Meta's cloud business plans raises concerns over the speed of the AI build-out. Receding risks. Fed Chairman Kevin Warsh says that price pressures have eased, but the fight against inflation continues. We'll preview the US payrolls report due today ahead of a public holiday. And crude prices ease for a third straight day as a US official says the oil flows through Hormuz have now hit 10 million barrels per day. Well, welcome to Thursday, 6:30 a.m. if you're just joining us here in London. And we have got this semiconductor sell-off having been around the world and really now affecting the Asian session. The MSCI Asia Pacific Index down more than 1%, dragged down by the Kospi, which is now down 5.5%, as you can see on the left. But it's a catch-up trade, so futures on both sides of the Atlantic actually pretty flat as things stand. So signs of stabilisation coming through for the day ahead here in the US and Europe. And if you flip the board over to the cross-asset picture, you can see partly why. We've got oil down, Brent down nearly 1% at $70 a barrel now. This on the flows through the Strait of Hormuz picking up, as I say. Treasuries holding their losses, though. We are on the 10-year at 4.49, up a basis point. And do note that the trade in cash treasuries closes early today at 7 p.m. London time. But gold rising for a second day. $4,000 an ounce plus again today. This after Fed Chairman Kevin Warsh said that price risks have come down in recent weeks. So bond traders perhaps a little less convinced of that narrative compared to those trading gold. We shall get back into the Fed story in just a moment, but let's take a look at the front pages this morning. We'll kick off with the Financial Times. It reports that OpenAI is in early talks for a public ownership deal that could see the Trump administration taking a 5% stake in the company. So just another big tech story to throw into the mix this morning. We also have the Wall Street Journal leading with a piece saying that around 2/3 of investors in President Trump's crypto coin have lost money after the president's finances revealed that he'd made $1 billion on crypto deals, as we discussed yesterday. And then here in the UK, we've got the Telegraph focusing this morning on England's late win against the Democratic Republic of the Congo, saying that striker Harry Kane's 2 goals saved the country's World Cup and manager Thomas Tuchel's job. What a relief. Well, you can get a roundup of all the stories you need to know to get your day going in today's edition of Daybreak, which terminal subscribers can find by going to DAYB Go. Well, just 3 weeks after the European Central Bank unanimously raised interest rates in response to the Iran war, there's no consensus, as we've been hearing from Zoe Schneeweiss, on what to do next. Divisions between central bankers over whether borrowing costs must rise further to get inflation back to 2% really surfaced at Sintra during the annual symposium.
We've all looked around and we've seen that prices are too high, and I don't think I'm the only one on this stage that's recommitted to deliver price stability.
I think risks, by the way, that we have to the upside on inflation and to the downside of growth are probably more broadly balanced than they were a few weeks ago as a result of what we're seeing.
It is very frustrating. I was very much of the view that we were going to have inflation back at the 2.0 targets, in the late spring.
There's a lot of uncertainty out there. Those risks could shift quickly. And the other part of our message is, if the situation changes, we're prepared. We're prepared to take action.
Let's get the thoughts of Hetal, Mehta, Chief Economist at St James's Place now. She joins me here in the London studio. Great to have you back. So I'm going to start off with Kevin Warsh, because it was his day yesterday, really, given it was his first appearance as Fed chairman on the international stage. Do you see him as a hawk or a dove now? Because you had comments from him talking about price risks coming down in recent weeks, but then reiterating all that he's also said about getting back to that 2% target.
I think it's really hard to kind of pin him in kind of any particular corner at the moment, and I think he himself probably is still trying to navigate exactly where he sits on that spectrum of hawk dove. So traditionally, people thought he was very hawkish with his views on balance sheets, but then with the kind of interest rate profile that he previously advocated, it's quite a difficult one. And obviously with these task forces that he's set up, which will report many of them by the end of this year, I think he's probably using that as a way to actually buy himself time before he has to be very explicit in terms of whether he's a hawk or a dove. But we know some of his long-term views, particularly around AI, and he reiterated that the productivity benefits for him would mean more supply side, which should mean reduced inflation pressure longer term. So that leans a bit more dovish.
Yeah, you mentioned the task forces. We've reported that a senior aide to Scott Bessent is going to become an advisor to Kevin Warsh. Obviously, you've still got all of that pressure from President Trump on Warsh to cut rates. How much do the concerns about Fed independence continue to linger?
And they're quite significant. I mean, Jerome Powell's still obviously around as well, so kind of maybe a bit of a counterbalance. But I think there are some questions that will linger for quite a while. As we heard from all of the kind of central bankers in the brief clip, they're all committed to price stability, but that means different things to different people. And we know over previous inflationary episodes, for example, the Bank of England has been much more willing to tolerate higher inflation than, say, the ECB. And so I think only time will really tell on that.
And again, we heard from Kevin Warsh on forward guidance. What does the end of forward guidance actually mean for markets? Do you think that maybe we'll see the end of the dot plot altogether at some stage?
It may be phased out. It was, some of these forward guidance measures really came at a point in time when rates had got to rock bottom. How were central bankers expected to keep the front end of the yield curve pinned down? We're not in that environment. We're not kind of post-financial crisis. And so maybe moving with the time, some of those things can be phased out. I think it's fair to say that markets appreciate them at various points. At other times it's also very confusing. You have a lot of communication from all the central banks, and it can sometimes be more noise because you see one thing on a dot plot and then you hear something different in the commentary.
Yeah, but I mean the situation in inflation is changing so much that maybe that's fair enough. Just in terms of the job numbers today, I note that Warsh hardly even mentioned the labour market, but what are you expecting?
So I think what we've seen over the last few months is, say, good numbers, upside surprises. For me, that really is so far only kind of offset the weakness we saw at the end of last year, so with the US government shutdown. So I think the consensus numbers for today are obviously, for another reasonable pickup. But I would be kind of hesitant to expect a very strong kind of upward trend from here, particularly if you've got the immigration side where the supply of the labour market is somewhat constrained. The uncertainty around policy probably hasn't lifted enough for US firms to be very gung-ho in job creation. And even if there was, you might then hit some capacity constraints and start seeing wage inflation come through.
And what about the European picture? Is it too soon to write off a consecutive hike from the ECB?
With the ECB, you can never really tell. But I do think the oil picture has changed significantly. As Christine Lagarde said, even in a few weeks it's shifted. It does feel as if, a few weeks ago people thought the inflation peak would come a bit later, particularly the echo of core inflation. But now for the ECB, they can see that actually the near-term effects, the month-on-month effects, really starting to show that's dominating the inflation profile we saw with the weak inflation numbers. So I'd be surprised if even if they did hike, whether they would really commit to a continued path from there.
And let me just finally ask you what you'd think if you got a Chancellor Ed Miliband here in the UK. Would you be worried for the UK economy and markets?
I mean, it's not about individuals. I think it's really about policy. If all of the kind of chancellors that we have commit to the fiscal rules and think very kind of more holistically around what does the UK economy need, I think we shouldn't be worried. If there's a commitment to investment, if there's, fine, borrow more as long as you're channeling it into growth, I think markets would be a bit more relaxed.
Right, Ed, if it's you've heard the conditions you need to meet. That's Hetal Mehta, Chief Economist at St James's Place. Really nice to see you. Thank you. Well, coming up, Hayfin defies the Angst, raising more than €15 billion for its new private credit fund. We'll have an exclusive conversation with its co-head of direct lending next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:42 a.m. here in London. And we turn now to private credit, because for all the industry's woes, Hayfin Capital Management has just raised more than €15 billion for its new flagship direct lending fund. I'm pleased to be joined by Marc Chowrimootoo, who is Portfolio Manager and Co-Head of Direct Lending at Hayfin, and he's with us for an exclusive conversation. So I can't underscore enough really how significant this amount is in the context of the industry at the moment. 15 billion euros. Bravo. Is it more a pro-Europe story or is it an anti-US story that's got you to this point?
I think there's some tailwinds which we've received through some structural tailwinds that we've received through what's been going on in the US private credit market. But I think a lot of it speaks to the support and the willingness of institutional investors to invest in Europe and the growth in Europe, and in particular the growth in direct lending. I'd like to think that there's a little bit of that's due to us and the job that we do, but I think it's a more pro-Europe discussion.
Well, yeah, I mean, there aren't many fund managers capable of raising 15 billion euros plus in this environment. As fundraising gets more concentrated, do we see smaller funds being consolidated into other parts of the industry?
There is a risk that over time scale becomes increasingly important, and it makes the smaller funds who have less capital, who have less access to talent, people who actually originate deals, they have less strong relationships with the users of that capital, become marginalized and either move into different parts of the market or actually become consolidated in the larger managers. I think what we've noticed in the last couple of years is an increasing flight to quality. So investors really trusting the managers who have scale, the managers who have reach, who can originate and actually execute on delivering risk-adjusted returns.
And what explains this prolonged slowdown in M&A, in your view? Is it simply that, private equity firms aren't willing to sell at lower valuations?
There is definitely a mismatch between where those portfolio assets have been booked, where they were done. And if you think about the scale of the M&A that we saw in 2021, both in Europe and in the US, where we saw record levels of M&A, but we also saw them at zero interest rates, at elevated leverage levels. Not a lot of those companies have grown into their capital structure. Not a lot of those companies have been able to really justify that valuation in today's market where we've got elevated rates. We've got elevated, although falling, inflation. We've got more macro uncertainty today than we did then. It's just that there's a real disconnect between where fair value is and where those values are in those assets.
But then, given that environment, is there a point where private equity firms are just going to have to eat the lower valuations and accept it?
The point of capitulation is one that everyone talks about.
Yeah, where is it?
Well, we haven't reached it yet, have we? Because I think we're still seeing relatively mediocre levels of M&A. I think that gap is narrowing. Right? It's clear with every single year since 22, with every single super return conference, you hear the narrative changing. You hear a more willingness to move on. And quite frankly, there's a backlog that needs to get put through the system.
Yeah, because if M&A stays sluggish, what does it mean for private credit?
It's a good question. And what typically happens in periods of low M&A is that you rely on your portfolio. So it's unsurprising that in the last 12 months, 60% of what we've been doing at Hayfin has been coming from the portfolio and 40% from new M&A. On a long-term average, if you look at that over 15 years, it's more the other way around. It's more 60% from M&A and 40% from your portfolio. We've deployed $7.5 billion in the last 12 months. So a lot of that has come from the portfolio, but that also supports managers of scale. Those that have the largest portfolios, those that have been around for 16, 17 years, and those that continue to transact even in periods of slow activity.
Okay, I also want to ask you about AI, because I wonder if it's changed the way that you are assessing credit risk, and if there are sectors that you just wouldn't touch with a barge pole, i.e. software.
It's the question that always gets asked.
Yeah.
I mean, we have a pretty good story to tell around that. Less than 6% of our vintages have software exposure. The current vintage has less than 3%. But even with those relatively low numbers, we do continue to assess opportunities as they come through. I think what's changed is the framework in which we look at those assets has changed. We're really digging down into what are the assets that have real domain expertise? What are the assets that have real ownership of data? What are the assets that have a sort of regulatory or critical end service, and really focusing on those as opposed to the ones which are more susceptible to disruption from AI. But the reality is we've not actually seen that much disruption in performance. Right? So if you look at what the software assets that are in most managers' portfolios, they're performing well. But it's the view as to what's happening. What are the ones which are more likely to be disrupted over time, which is the problematic point.
Okay, so it's a worry that may not be fully justified, but still worth having the.
It's a worry on the horizon, and there will be winners within that sphere, and there will be those business models which are disrupted. What we're all trying to figure out is like, where does your portfolio sit on that basis? But like everything, if you've got 20%, 25% in software today versus less than 5%, you're probably going to be feeling a little bit more nervous.
Okay. Marc, thank you so much for coming in to see us. Marc Chowrimootoo there, Portfolio Manager and Co-Head of Direct Lending at Hayfin. Nice to see you. Well, let's pivot now to the defence sector because tank maker KNDS has postponed its IPO, citing market volatility in the European defence industry. The delay is particularly significant as the sector's been a bright spot for Europe in an otherwise slow year for debuts, as we were just discussing with Marc. To tell us more, I'm now joined by Bloomberg's Charles Capel, who's been all across this IPO for us. Marc, Charles, tell us more about what's led to this delay.
Yeah, so as you said, the official reason that was cited by the company was some volatility in the European defence sector. What we've seen is that the European defence sector sort of listed stocks, they had a really, really strong rally at the beginning of the year, and the steam has started to slowly come out of that rally. Now, there was one event on the day that KNDS announced their plans to list, which could have made things a little bit worse. And that was with relations to Rheinmetall and the German government deciding to hand a contract to build some military ships to TKMS, which is another shipbuilder. Now, that sent Rheinmetall shares down about 19% on the day. In the days that have followed, the shares have started to sort of slowly recover and trying to come back a little bit, but it seems to have shaken a bit of confidence. We're reporting that investors were sort of looking at that. It's very difficult when you're planning an IPO to try and get the right valuation because you're selling shares essentially pegged against the valuation of the key peers. And Rheinmetall is KNDS's key peer. And then the other aspect of this is that it was the German government. And at the same time, the German government was going to take a 40% stake in KNDS as part of the IPO. And so there are these questions over, how did that happen? So that the German government, on the same day that it was announcing a really, really important offering, it also announced this news, which really shook the confidence in one of the key peers. It does look a little bit messy, and so we're sort of trying to find out a little bit more about that one.
Well, is it a bad omen then for the whole of Europe's defence industry?
Well, look, I think there is a real move to get more European defence stocks listed. And as you said, it has been one of the bright spots in European equity capital markets so far this year. Generally, if you are a defence company, then you can raise funds, or if you're a shareholder, you can raise funds on European stock exchanges. It does show perhaps a little bit of a weakening in investor confidence in this trade, which is essentially fueled by the idea that there's going to be sustained higher spending on defence by European governments. And perhaps investors are starting to question, well, how long does that run? And perhaps the current stock prices and the current sort of valuations, are they overvalued or are they perhaps undervalued? And it indicates that there's a bit of a bit of a lack of confidence with investors on that particular trade.
OK, Charles, we'll see if this shakes the sentiment in the sector this morning at the start of the European cash trade. But for now, Bloomberg's Charles Capel, thank you so much for bringing us that story. We've still got plenty more coming up on Bloomberg Daybreak Europe. Don't go anywhere. This is Bloomberg.
An important piece of the substance of the evidence for us is that we've got a softening economy. A softening labour market, we're seeing some softening of activity. we think we've got a bit of an output gap opening up. And we had that before the hostility broke out in the Gulf. So that's the contextual setting.
Bank of England Governor Andrew Bailey there speaking at the ECB forum in Sintra. We also, of course, heard from Kevin Warsh, the Fed chairman. You can contrast their views. Warsh talking about how price risks have come down in recent weeks. And take a look at this terminal chart, because as you can see, energy prices and short-term inflation expectations have fallen in tandem. So that suggests perhaps there's less need to worry about second-round effects here in the US. Now, flip the board over, because we can also see how the oil drop could bring the Fed to a more neutral stance. But this all focuses on the inflation side of the mandate. And, of course, we've got more data coming on the other side today. Flip the board one more time. On the payrolls front. So let's look at the expectations for the data today. In terms of unemployment, expected to hold steady at 4.3%, same as in May and June. But when it comes to non-farm payrolls, such a spectrum of expectations. The expectation on the consensus is 113k. The whisper number, 138k. Bloomberg Economics says 200k in June. And what sort of action we could see in the bond market off the back of that, especially with a shortened day for trade in cash treasuries. So keep an eye on potential volatility if we get a big number like that. But coming up later on Bloomberg TV, we're going to be hearing from CEOs of trading app Robinhood and dating app Grindr, both of those on the pulse with Francine Lacroix. And the opening trade will be coming up next. Anna Guy and Tom will take you all the way to the start of the European cash trade at 8 a.m. So stay with us. This is Bloomberg. Good morning from London.